So welcome all to the seminar in the Departamento de Economía y Finanzas from the División de Economía y Ciencias Económico-Administrativas de la Universidad de Guanajuato. So today we have with us Dr. Supratim Das Gupta. Dr. Supratim started studies in economics in the University of Calcutta and then got his PhD from the University of South Carolina. He joined us in the FEA for a while before moving back to India, and currently he is working at the University of Ahmedabad in the Amrut Modi School of Management. And today he's going to present two papers with us. So the first one is Investment Style Consistency and Performance of Indian Fixed Income Mutual Funds. And with two co-authors, that's joining us, Mahvat Patel, and well, I don't see the slide anymore, so I cannot read the second name, but it was with Windu.
Oh, yeah, where is the slide?
I don't know, it disappeared. So Luisa has the slides. So
Luisa, le comparto. Okay.
Could you share the slide, Luisa? ¿Puedes compartirle la presentación?
How many participants do we have? We have, I mean, why is... I don't see the participants. I don't know how to see that.
1, 2, 3, 4,
15
5,
participants we have.
15, yeah.
15. Okay. Where do we see that? I mean, in Zoom, I know this is a new, I mean, my first time. In...
You should see like there's upstairs, it says participants. It's like two small
Yeah. Show participants.
You click there and you
I've
see
seen,
the list.
I've seen, yeah. Leonel, Mariana Guadalupe, Mike Patel, Windy, Ana Maria Sosa. Okay. Ana Karen. Sure. Great. Yeah. So the slide. Yeah.
With no further delay, I mean, you can start your presentation. Please go ahead.
Yeah. So it is a. Should I share my slide, because then I can move faster? No, it'll be easier for me.
If you can, it would be better. So, Luisa,
yes.
deja tú de compartir y que comparta Supratim.
Sí, déjeme compartir. ¿Dónde doy la clic, Luisa, para compartir?
La flecha que está al lado de salir, arriba, tienes una flecha que pone salir. Perdón, el salir rojo arriba. Y al lado hay una flechita. Y la flecha es para compartir contenido.
Dios mío. No lo veo.
A ver, Teams, donde está el botón para salir de la llamada, un botón rojo grande.
Sir, the arrow, rectangle, an arrow in that. You need to click on that.
I don't see any arrow.
It's the arrow.
Just besides the leave button.
There's an arrow that's for sharing content.
Yeah. Now where is my content? Hold on. Okay. No, it's very different. So okay, no problem. So then I think if I click on this again. See? Can you see?
Yeah.
Yes.
Okay.
Please make it a presentation mode so that we can see the full.
That's the other one. I don't know if you want to start from which one.
So this way, if I change slide, can you see?
Yeah.
But this is a different presentation, not the one that we.
Yeah. No. I mean, this is the first part. I mean, I'm just going.
Yeah.
Here.
Okay.
Can you see?
Yes.
I mean, if I change.
Yes.
And the thing is, how do I see myself?
You don't see yourself. I mean, if you are sharing content, you will just see the content, and then our videos if they are on, but you won't see yourself.
I don't see you also. That is why I'm asking you. I mean, it's very. I mean, in Zoom, for example, I can see both, but.
In this also it is possible to see both, but I think we need to try that.
Too hard.
It is, you have to go in the three dots.
Espere. Stop sharing. So am I still sharing?
Yes.
At least for now, I cannot see the slide, but you seem to be sharing something.
Oh shit. Okay.
Now you're not sharing anymore.
Yes. I understand that. And then no. Okay. Yeah. Don Fernando está muy complicado.
It's very complicated, Supratim. You can make it. You learned Spanish in 2 months. You can do it with Teams. You can easily do it.
It's just a ridiculous, thing that I'm not being able to understand. Okay. Okay, then if I do it again, it should. Okay, now let's see. Okay, now I go to Teams, but then this is the problem. Slide share. You can see now, no? Okay.
Yeah, you're sharing.
Yeah, okay, now I think I can see on the side. Yeah, I can see Fernando. Okay, so thank you for the opportunity. Is it in full screen mode? Is it, or should I?
No. This is not full screen mode.
You should start the presentation and it will go to full screen mode.
Yeah, now I can do it. Yeah.
Now it's full screen.
Yeah. I have figured it out. Okay, great. So thank you for the opportunity, everybody. I'm very glad to present to my former colleagues. A lot of you are here, and I also see a couple of former students, Windy and I think one more student. So thank you. Let me start. So this is a work with Mayank Patel, who is here. He's a doctoral candidate, me, and Vinod Madhavan, who is the supervisor or guide of Mayank. So the study is of mutual funds. The study is regarding mutual fund, the performance and their the investment style for mutual funds in India. So first of all, what is a mutual fund? So mutual fund is a type of financial vehicle, which you can see it is from Investopedia, is using a pool of money which is collected from many investors, and it is to invest in securities like stocks, bonds, money markets, and other assets. So, and the most important thing is the mutual fund, a mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. So then why do mutual funds exist? Of course, to bring together cash strapped or cash deficient businesses with cash surplus investors. And then mutual funds offer certain advantages like liquidity, ease of access, diversification, professional management, and in case of India, I'm not sure of other countries, it also offers tax benefits. So if I put some money in a mutual fund, I get some tax deduction at the end of the year. So then this is the growth of the mutual fund industry in India. So the source is the Securities and Exchange Board of India. This is the governing body which manages all the securities trading in India. And you can see, and AUM is asset under management. So this is in billions of Indian rupees. So for everybody here in the presentation, 1 Mexican peso is more or less 3.7, 3.8 rupees. So if you divide this by 4, more or less, or 3.7, you'll get the number in Mexican pesos. So this is in billions of Indian rupees. And the most important part here is that you can see a very clean upward trend in the assets that are under management in India for mutual funds. I will show you certain examples because even when we started this, I was not very clear of mutual funds. So the whole credit goes to Mayank. So Mayank is much older than us, and he has been working in this industry for a very long time. So this expertise about mutual fund data comes from him. We helped in the analysis part and giving some insights. So this is the mutual fund industry. This is again from SEBI, Securities and Exchange Board of India. As you can see, once again, this is the proportion of the distribution of where mutual funds are. So we have seen a steady rise in fixed income mutual funds. In case of equity funds or stocks, mostly we have around like more or less a steady percent, 20, like 30%, 32%, 27%. For hybrid funds, which are both, which offer both fixed income securities as well as equities, we see again, actually it was higher in 2000 and the share has declined or did decline up to 2015. It picked up a little bit in 2020. But there's a very big concentration in fixed income mutual funds. And so this is the division of the in terms of the percentage and the significance, as you can see. So the fixed income mutual funds, especially for India, are quite important. So the question is, so given this vast amount of assets which are managed by mutual funds and the economically significant role which are played by mutual funds to connect the investors and financial markets, there can be questions on performance evaluation of mutual funds in India. So what do we mean by performance evaluation? So basically, are they performing over their benchmark? So the evidence of selection ability by fund manager means that are the mutual fund managers, because that is one of the advantages of a mutual fund, that the fund manager, so there is an experienced fund manager who is of whom you can take the benefit of, and there is a fee, of course, fund management fee, which is 1% to 2% of the assets. So do we see some kind of a selection ability for the fund managers? So do the fund managers manage to outperform the benchmarks? The other question can be that does past performance determine current performance for a particular mutual fund? And the other thing is, do we see that investment follows particular style as prescribed by the SEBI? So what do we mean by style in the first place? So basically, the Securities and Exchange Board of India, SEBI, first of all, allocates mutual funds into various categories, fixed income funds, for example, because in this study, we are only concentrating on the fixed income funds. So for fixed income funds, the SEBI says there can be 16 categories of fixed income funds, and the mutual fund companies, which are known as asset management companies, they say that given the SEBI's objectives, our mutual fund or our product, our securities, falls under this category. Like it can be long duration, short duration, dynamic duration, money market funds, all of them. So then, if that is the case, then the mutual funds in India, they have to they are saying that, okay, my fund is falling under this category, and I mean one of those 16 categories. And then the style means that when they are investing, they should be, I mean, ideally speaking, according to theory, their weight should be more on the benchmark, which we see sometimes, which we don't see sometimes. That is why the question becomes interesting, and that is what we mean by style consistency, and its relation to performance for Indian fixed income funds. So do Indian fixed income funds demonstrate any style consistency? And secondly, what is the meaning of, I mean, how is it related to the performance of Indian fixed income funds? So that is kind of the question. Before I go to the literature, or probably let me go to it, and then I want to show you some, some numbers or some examples where this may be a little clearer. Anyway, so the literature, I put it very briefly that we are studying, of course, the performance evaluation of mutual funds, and there have been no studies as far as India is concerned. And in general, for less developing countries, or in general for developing countries, study of mutual funds has not been very common. I presume that it is the same for Mexico. There is some scholarly literature on performance evaluation of fixed income mutual funds, but again, it is scarce and also recent, because we see, in the 1990s, certain papers, and Clare et al. 2019, Domian and Rickenstein 2008, 2009, these are kind of the very landmark papers, but they have been few and far between. And as I said, we focus on the investment style analysis and the analysis of the returns and holdings of a fund with an objective to draw inferences about the types of biases and quality of views of the fund manager. So basically, as I said, when we're talking about style analysis, it should be, the investment should be more on the benchmark, which we don't see, which we see sometimes and we don't see, and certain conclusions can be drawn based on that about the biases of the fund manager, if any. It is also the analysis of returns and holding of a fund with an objective to draw inferences about the types of oh, there is a typo here. I copied the same thing 2 times, so I'm sorry about that. So we are also, of course, analyzing the holding of a fund. And we also see distinct differences in investment style across bond fund classes. So across various bond fund classes, across various categories, we see that there are distinct investment styles, like across various fund categories. And we are also trying to relate the performance of the fund and investment style, as I said, kind of the performance evaluation between the investment style weights and holding, which is related to the fund performance, if at all. Give me a second, let me check this one. Connect the charger. This laptop will go out of charge very soon. Okay. Okay, so let me give you some examples. So let me see. I saw that. Stop presenting. No, that's ending the meeting. This is stop presenting. Let's see how this works. Okay. I go to the meeting again. I start presenting and I do this guy. Okay. Is it visible? Hello?
Yes, it is.
Yes, it is.
Okay. So this is, for example, this is an equity fund. This is an equity fund. This is not a fixed income fund. So I wanted to show you. So this is, for example, an asset management company, which is SBI Mutual Fund. And this is a particular scheme, which is an equity scheme. So they are investing in shares and stocks. So this is SBI Long-Term Equity Fund. And this is a portfolio statement. So as of October 31st, 2021. So as you can see here, this is how they are investing, for example, in all these companies: ICICI Bank, Tech Mahindra, Larsen & Toubro, ICICI Prudential, Crompton and Greaves, Axis Bank. So there are like about 70 odd companies over here. And this is the industry. I mean, this is the industry that it deals with. For example, Tech Mahindra is a software firm. State Bank of India, which is a bank. Actually, SBI is the mutual fund company, which is from the State Bank of India. You have HDFC Bank, you have Mahindra and Mahindra, which is an auto company, and these are the quantity. I mean, this is the number of the shares that they are buying for these from these industries or from these firms. And this is the market value. This is in lakhs of the rupees. So lakhs is 1 lakh is 100,000. So this is this unit is used in India. So it is 59,481.93 thousands of 100,000 of rupees. So again, if you divide it by 4, more or less, you'll get the value in terms of Mexican pesos, for example. So you can see this is the market value of these individual equities which the SBI mutual fund company is investing in. And this is one of the products. It's a long-term equity fund. Why is it a long-term equity fund? Because the lock-in period is 3 years. If you invest money here, which I actually do in this case, I would not get the money back before 3 years. And this is the percent to the asset under management. So the total market value, as you can see here, this is the total market value. It is 1,053,148.44 lakhs, and we are accounting for about 94% of the assets under management, because this last company there's no market value, as you can see. And if you take into account one of the other assets that they have invested in, and some other investments, you account for the total market value, the asset under management that this one company, SBI Mutual Fund, as of 31st of October 2021, this is coming to around 1,109,446.09 lakhs of rupees. So lakh is again 100,000. 1 lakh is 100,000. So then if I again go to what are we exactly trying to do? So this was not possible for me to put in the presentation because of the sheer size. I mean the size of the file. And I'll also show you something else over here. Where's this guy over here? What do you see? Do you still see the presentation, right? Sorry, the Excel file.
Just still presenting something, but I see it at least as gray. I mean, so I don't see content.
But you could see content, the Excel file, right? Now you don't see.
Yeah, the Excel file, we could see the content of the Excel file, but now I'm just seeing
nothing.
Gray stuff.
Okay. No, I think I have to stop presenting, and I'll show you one more thing. So yeah, can you see this now?
Yes.
Yeah, so this is the paper that we have, which is under review in one journal now. I mean, just like submitted, just submitted. I'll come to this. I'll just give you the broad outline because this has a lot of data over here. So this table, I think this is a very simple table to understand. This is also in the PPT if you have gone through, but I wanted to give you an idea first. So these are all fixed income mutual funds. So if we ignore this column of cluster for now, let us ignore this column. Let us just concentrate on the fund category for now. So there are overnight funds, which is one fund category. So there are number of company and number of number of companies or asset management companies which are having overnight funds. Liquid funds, again, ultra short duration funds, low duration funds, money market funds. So this is one type of fund category. I mean, we have clubbed them together in a cluster called liquidity. But similarly for duration, we have also clubbed these duration funds, medium duration, short duration, medium to long duration, dynamic duration, in one cluster for duration. Similarly for credit risk, which has high risk, high return, yield funds, which are government securities, and floater funds. So we have also put them in one cluster. Now, but to re-emphasize this again, this one cluster is not fund. So there can be multiple funds in this one fund category. I mean, in the overnight fund category, there are multiple funds in short duration funds, so on and so forth. So let me show you that table. So you can see here, table 2 starts from here. So you can see here, so overnight funds, the number of funds as of March 2020, we are taking 5-year data, April 2015 to March 2020. The number of overnight funds in, number of funds in the overnight fund category, this is 30. Number of funds in the liquid fund category is 39. Like in the Excel file I showed, that's one fund, but that's an equity fund. We are talking about fixed income funds. Number of funds in the ultra short duration category are 29, so on and so forth. So in total, we have, as you can see here, we have 16 categories, and the total number of funds are 329. For our purposes, we are considering 254 but finally we have boiled it down to 242 because of certain data like limitations for certain funds. But the most important thing is the SEBI's definition of fund category. This table is what defines of any fund in the category, let's say of gilt funds. There are 21 funds. How do they project themselves as a gilt fund? It's not this classification has not been done by us. The fund, any fund in their prospectus, they are saying based on the SEBI's definition of fund category, because SEBI is just putting this outline that there are 16 fund categories, and there is each 16 fund categories. Each fund category has this definition, and an asset management company, when it is launching a fund, it is saying, okay, based on the SEBI's definition, our fund is a gilt fund, or our fund is a banking PSU fund, or a credit risk fund, or a long-term fund, whatever it is. Okay, so this SEBI's definition of fund category, this and the objective, these two columns. I mean, this is a very tedious work which was done by Mayank to put this in an Excel file and to each fund to get their objective and to put it in a table. This was a lot of work that he has done. I must give due credit, of course. So then what we are doing is we are putting similar funds. This is our subjectivity, that we are putting these funds, the overnight funds, in a liquid category because they are the most liquid, because they are low duration or money market funds which have a maturity of less than 1 year. So this clustering has been done by us. Okay. So let me go to the data, which I have probably explained mostly, but let me go to the data and show you some of the results. I'll pause here, or should we take questions later, or should I pause and ask questions if you have any?
I mean, as you wish, but usually, I mean, if we have a doubt, usually we will ask you directly.
You can. I mean, anybody has any doubt till now?
No, not until now. I mean,
not until now. Okay. So you see the presentation, I guess, again?
Yep.
Yeah. Okay. So then this is the question that, as I said, sorry. Yeah. The data is about we are doing very standard practice in the literature for the return-based style analysis for 242 Indian fixed income mutual funds for 16 categories, as I said, over a period of April 2015 to March 2020. And we are having a monthly holding period returns of the fund over 22 benchmarks. The benchmarks I will explain, and some of the so again, one of the risk-free return that we are taking, that is the yield on the treasury bill and Government of India securities. And this was already explained to you. I won't go into this, that the SEBI, the Security Exchange Board of India, this is the mutual fund regulator, has notified 16 mutually exclusive and collectively exhaustive categories. And we have certain average Macaulay's duration, which is the duration of the fund more or less. And we are categorizing the individual asset management companies, when they're having a product, they are putting their product in a certain category based on the Macaulay's duration. Okay, so so this, I would not probably spend time on this. I've already given you a flavor of this. So the number of funds in the sample, overnight funds 4, the total number of funds 242. Okay, so let's go to the, okay. So this is previous to the style analysis that we are doing, previous to that, a broad selection ability. So what is a selection ability? So these are two equations. One is a multi-factor, as you can see, more factors over here. One is a single factor model that you have RPT. This is the monthly HPR. This is the holding period return at time T for a mutual fund P. And RFT, this is the monthly risk-free return. That's the yield on the treasury bill, government securities. And excess return on the market, this is the MR minus RFT. This is the excess return on the market. So then the question is, what is the, so what is the market return? So MR is the market return. So the market return is the CRISIL Composite Bond Fund Index. So CRISIL is a very well-known firm, and the data is very reliable for India. So it gives this composite bond fund index, and that we are taking to be the market return. So basically, what are we doing? So the monthly holding period return, so the monthly HPR, adjusted for the risk-free rate, which is the yield on the treasury bill. How is this performing with respect to excess return of the market? So the excess return, which is the CRISIL Composite Bond Fund Index minus the risk-free return, and you have a white noise term here. Multi-factor model, which is an extension of this one. You have the monthly return again for the holding period return, excess of the holding period return. Now you also have excess return on the benchmark. So the benchmark will differ for each fund, for each fund category. For each fund category, the benchmark will differ. So now you also have the excess return on the benchmark. You have the same thing, excess return on the market. You have the term spread, which is just the, as you can see here, it is the steepness of the term structure, which is the monthly returns, the difference in the 10-year gilt index minus the monthly returns of a 1-month treasury bill. The credit spread is the monthly return of the CRISIL A medium to long-term index minus the monthly return of the CRISIL AAA medium-term index. So this is the credit risk. The credit spread, term spread, and this is again an white noise term. So this is the premise. So what we are going to basically tell you, let me go here and then we'll come to that. This is the focus of this paper. All these equations are basically the whole dissertation of Mayank, and the previous have been divided into a separate chapter, and this is a later chapter, but there is a very strong relation between the two, and we are going to explore that to a certain extent. Now we are doing the return-based style analysis. So what are we doing? We are saying the returns of each fund. This is the total return of a fund. This should be exposure of the fund. This is the exposure of the fund to asset class P. This should be based on the others. Like you have the on the total the return of the asset class P. So you have various asset classes, and one of the asset classes would be the benchmark. So what we are saying that the investment for the fund I, the investment style should be divided into various asset classes, as you'll see, and one of them is the benchmark. So do we see a high weight on the benchmark or not? And to minimize the sum of squared errors, this is a technique, and this is the realistic case, that the sum of the weights, or the sum of the regression coefficients, they should equal 1, and each regression coefficient cannot be, it has to be in a closed interval of 0 to 1. So this is a constrained regression technique that we are doing this regression imposing these two constraints. This is from Sharp 1992, Atkinson Joy 2001, and the technique that we use is called quadratic programming, and you can see here. And then the regression, that the R squared that's coming out of the quadratic programming, once we do this optimization, this is the measure of the fund style consistency, and 1 minus R would be the fund style inconsistency. In some other terms, you can also call 1 minus R square as the selection ability of the fund manager. Why is it the selection ability? Because they are not following the SEBI's the guideline, that is what the results show us, that the distribution of the weights of the various asset classes, it is not concentrated on the benchmark. And the selection ability can also be related, or it is the same thing, not exactly the same thing, but it can also mean, the selection ability can also mean this, which is which can also mean the magnitude of alpha. So alpha is the Jensen's alpha, which is very standard in this. It is called Jensen's alpha, which is the terminology used in this literature, as you can see. So Jensen's alpha is the intercept term, right? In both of these cases, one is a multi-factor, one is a single factor. But Jensen's alpha will tell you that the selection ability of the fund manager, because all else constant, the excess market return, the excess return for the holding base, holding period return, the excess, the risk-free adjusted the return, how is this performing irrespective of the excess return on the market? So how is this performing? So that answer will lie in the intercept term. So the intercept term is the Jensen's alpha. So a larger intercept will tell you that there's a larger selection ability of the fund manager. So here, when we are saying 1 minus R squared, it can be called funds style inconsistency. It can also be termed as the selection ability of the fund manager. So this I have already shown you in the Word file. I'll go through I will skip this. So these are the results. So this, I have to just spend a couple of minutes on this. So here we are taking the averages for each of the fund categories. So if you remember, if I go here very quickly, if you remember, so these were the number of funds in each of these fund categories, and then we have taken these 4 as the liquid funds, and these as the duration funds, credit risk funds, so on and so forth. So we are taking, so how many regressions are we running? We are running 242 regressions. So each fund or each firm or each asset management company has, we are running a regression for those asset management companies, right? So there are 242 regressions over here, 242 regressions over here. What we are doing here is we are taking the average of the coefficients for the 242 regressions. So no, it's not for the 242, for the number of funds in the overnight funds, which are 4 funds. You can ignore the cluster average. Let us ignore that. Let us concentrate here. And the red symbols, the marked in red, they are the benchmarks. So the overnight index, this is the benchmark for the overnight fund. For the liquid fund index. For the short duration fund, the short duration index, ultra short duration index. For the low duration fund, this is the index. For the money market fund, this is the index. This is the market return, which is always excuse me. Which is always the CRISIL Composite Bond Fund Index. So, so what do we see here? We see that for overnight funds, there is style consistency, right? Because the number, the weight, the average weight on the benchmark is the highest, right? I mean, there are 6 regressors here, as you can see. One is the benchmark, the other 5 are the asset classes. So the weights are they are 0 or close to 0. The R square is 68%, as you can see here. 68% is explained. For the liquid funds, again, we see style consistency. But once you go to ultra short duration funds, once you go to low duration funds, we don't see style consistency, right? Because you have a higher weight on something that's not the benchmark. You have a higher weight on something that's not the benchmark. So ideally speaking, if you see the next slide also, short duration funds show a very high style consistency because the weight is almost, I mean, this is the short duration benchmark index. This is the weight is almost close to 1. And so it is almost perfect style consistency on the benchmark. Whereas for the medium duration funds, there is less style consistency. For medium to long-term funds, there is very little style consistency. For long-term funds, this is almost the result that we get. That, I mean, the constraint regression ideally should give you the answer that that this number should be 1 and everything else should be 0, and the R square is also very high. But please note that these are the averages for all the regressions for the long-term funds. So as you can see here, and this is again the as again you can see not a lot of style consistency for corporate bond funds, for neither the banking PSU or the credit risk funds. And you can see the R square is also kind of low, but there can be cases, as you can see here and other cases in the previous slide, that there's not style consistency, but the R square is very high. So there is a value to the regression, but there's probably high selection ability because I'm sorry, there is not high selection ability because the R square is reasonably high, but there is also no style consistency. Okay, so and this is the final category because we have divided into 4 clusters, but please ignore the cluster average. See, for gilt funds, again, we have a very high, this one, R square, which is saying style consistency is very high, but again, we don't see this being close to 1. For the floater funds, this is the equal weighted index. This is again the benchmark for the floater funds. We see moderate size, and R square is not very high. But what is the story that we are trying to take home from here? The story that we are trying to take home is that whether this, whether we can relate this to selection ability, not on for this equation, the previous equations where you had the single factor, multi-factor model, whether these results for investment style consistency or inconsistency can be related to the Jensen's alpha, the size of the Jensen's alpha. So this is we have done a Pearson correlation coefficient. As you can see here, we are doing the single factor alpha, multi-factor alpha, and the general result is, this is a very, very interesting result, and all 3 of us, me, Mayank and Vinod, we are kind of saying that how do we portray the story that like the result is funds which have high selection ability based on single factor or multi-factor tend to also do very good in investment style analysis. They also show reasonably high style consistency. I'm not saying the other way, that funds, some funds which are style inconsistent may also show high Jensen's alpha, but definitely the funds which show style consistency show a high Jensen's alpha. So probably there is some selection ability that is based on the Jensen's alpha that is also, that maybe that may depict some of the characteristics of the fund manager, and that is also probably spilled over to the style analysis when we are taking these asset classes, that how is the investment in these various asset classes, how much is it close to the benchmark. So we see a very high correlation both for the single factor and the multi-factor models. And this is more or less the story. And I have about a few minutes left. I'll go to the other paper, and before that, these are the conclusions and avenues for future research. That, as we have seen, that funds exhibiting better style consistency generally exhibit higher returns. That is the high selection ability, that they're outperforming the market. That, I mean, in terms of excess market returns, for the risk adjusted the returns, for the excess market returns, they are outperforming the market. So this is definitely a valuable skill of a fund manager, of being consistent with the stated investment style and showing good selection ability. And as we can see, and as we just saw, based on the Pearson correlation coefficient, that there's a positive linear relationship between investment style consistency and risk-adjusted performance. Some of the future works, as we have actually, Mayank was very interested, and we can talk more about access to some data for other developing nations' financial markets, Brazil, Mexico, China. And is this result that we are finding of this investment style or investment style consistency correlated with good selection ability, is this because of some identifiable or measurable skills of the fund manager? You know, it can be the age of the fund manager, the experience of the fund manager, the educational qualifications of the fund manager. It may also be related to gender. We don't know, but that data is very difficult to get, of course. You know, is it because of some skills of the fund manager that we are not being able to account for? So thank you. I will move to the next paper very quickly, and then we can take questions, I guess. So this is another work. This is completely different, and I just thought of presenting this because the other work with Mayank, and we know it has been submitted to a journal. So, but this work is very new, and this actually is my idea with other co-authors of Ishita Tripathi of Ahmedabad University and Meenal Pathak of Ahmedabad University. And the question is that changes in energy-related consumption induced by work from home, WFH, how much of this is likely to continue in future? Very simple question. That because of the pandemic, as you can see here, there was a change in energy-related consumption behavior because there was this option of work from home. So we are not really saying pandemic per se. The pandemic has just provided a natural experiment, and which has, as we've seen, that of government-imposed restrictions and lockdowns, when the option to work from home was available. So if there was something else which also induced people to work from home, that's okay. But we are saying that the pandemic provided us an opportunity with a natural experiment. And we investigate the question of how people have changed behavior with regard to household energy consumption and transportation needs because of the work from home option, not because of pandemic, just that the option was there. And we would also like to analyze how have people's behavior changed as most restrictions and lockdowns have been lifted. So in Mexico, in India, most of the lockdowns and the restrictions have been lifted. There is night curfew in a lot of places, as in Ahmedabad. from 11 at night to 5 in the morning or 6 in the morning. But except that, there is, it is pretty much normal as it used to be. So do people still make these similar choices for energy and transportation? And would they continue to make these choices in the future? Let's say in the next couple of years when things are even more back to normal, probably. Or probably it would, like, we would never get back to normal. I don't know, but maybe when even the curfews are not there. And why are we only concerned about energy and transportation? The energy consumption, as I'm calling it, and transportation. Why are we concerned about that only? Because the reason is that work from home have changed energy consumption in terms of appliances that you use at home, in terms of just simply the number of hours you spend at home. So more electricity is being consumed, more time is being spent on the laptop or the computer or on phones or on all of them. And that may also make some people become energy conscious. Work from home has the great advantage that you can multitask, attend meetings and seminars online, which we are doing at the moment. We can teach online, and as some students, I'm sure in Universidad de Guanajuato, students exploit the advantage of online classes as they do here, that some students are always asleep, right? They never join, they just log on to the meeting, they are asleep, and they get the attendance, which they never participate, which would not have been possible if it was a physical class. But again, multitasking, working from home also gives opportunities to some people who have children and aged family members at home to take care of them. So transportation, the people are also probably commuting less. And the limitation is, of course, that we are not considering the effect on people who do not have the work from home option, people like doctors and nurses. And we are also not considering the effect on materials, such as, people have started to order groceries online or food online or watch more Netflix at home and going even less to movies and all of that. So that is for a separate paper later. I mean, we are only concerned about energy demand and transportation demands. And one of the points is the work from home, as in the next slide. So this is the survey. I have shared the slides with Luisa. So I would actually encourage you to fill out the Google form. We would have more data from all over the world that would be really interesting, and we would be really thankful to all of you. And as of the moment, there have only been a couple of studies on the impact. There have only been a couple of studies on the impact of COVID-19 on electricity generation and consumption. So Pandey et al. This is actually a report in July 2020, which says about the electricity generation by the various electricity grids of India. This has nothing to do with consumer behavior. Yes, it has to do, but the paper is only talking about from the production side, that all these electricity grids, how was the electricity generated during the last, to 2019-20. So we see a drop, we see a rise in the electricity generation by these grids. Peak hour electricity consumption, we don't see much pattern there, if I'm not mistaken, but I have to read the paper again, but it's from the supply side. And Pathak et al., this is a more recent paper in November 2020. Actually, this is not a paper, this is a poster presentation, 2-page. This, I think, is a very interesting observation. What they have done is they have had this study in tier 2 cities. So in India, we have metros like New Delhi, Mumbai, Kolkata, Chennai. These are metros. Then you have tier 1 city. Then you have tier 2 cities. So tier 1, tier 2 cities are a little smaller with smaller populations. So they have done with two tier 2 cities, and they have not done any survey. They have not asked people about their electricity consumption, but they have just studied the data from the meters at home. The electricity meters at home. And what they've actually found is in a certain case, in a certain city, the electricity consumption has actually declined. And some anecdotal evidence, they have not done a survey. Some anecdotal evidence seems to suggest that, or they may have done a survey. I have forgotten that part, but they have studied the meters of the respondents in these cities, and they have definitely seen in certain cases the electricity consumption actually falling over the time of the peak of the pandemic, like early 2020, in the early part of 2020. I mean, after March, they have seen it fall, and one of the reasons that they're stating is the what is that? How do you explain? I mean, the unreliability of the household appliances, especially air conditioners. So air conditioners, large household appliances, if they get damaged because of use during the pandemic, it's very hard to get them repaired, because we are in a lockdown. You would not get any mechanics, you would not get any, you would not be able to fix it. So because of less use of heavy electrical appliances, the electricity consumption has fallen. And the reason, one of the reasons for not using electrical appliances as much is because of the probability of not getting anybody to fix it in case it gets damaged. So I thought that's a very interesting observation, and we have included those questions, in the survey. So I would really encourage you to fill it out. And that is it. So I'm done. I'll stop sharing, or should I continue to share?
Stop sharing. Thank you very much for especially for the first one. The second one, job in progress. So I guess we try to help you there a little bit. So thank you very much both for being present and the presentation. And we should then take some questions. So is people willing to ask question something?
I saw Windy, but I think Windy she's still there. She is my former student.
No, nobody. Okay, Fernando. Fernando is there.
See, Fernando.
Yes, hello.
Yes.
Well, about the first paper, very interesting, very nice, and I don't know if you should maybe come back to share again and to see about the factors model. I'm not an expert on the topic, but I would like to know why it's different from I don't know, a Fama and French model, just to have a small capitalization and high capitalization. Why is it a bit different, or is it clustered in some other way that you capture maybe the small and high capitalization?
Yeah, can we also ask my co-author to answer?
Yes, Any.
Larry, is it okay?
Yeah, sure.
Mayank, yes, you can answer. Pharma French, that's a classic paper, yeah.
Yep.
Your mic,
Mayank,
your mic is off.
Mayank, yeah.
Yeah, sorry. I think Fernando referred to the Pharma French three-factor classic model. Now, this model is more applicable to equities, because small cap, large cap. This is a concept related to equities.
Equities.
The third, one independent variable in the model is market return. There is the difference in the returns of large cap and small cap. Again, a concept related to equities. The third independent variable in the Pharma French model is the difference in the return of high price to book value and low price to book value securities. Now, all of these factors are related to equities. So, whereas the independent factors related to the performance of fixed income securities are different, we have tried to capture those factors. So, one factor that we are capturing is the market return, similar to the Sharpe model. Another factor we are capturing is term spread. The returns on fixed income securities are related to the time duration for which the returns are targeted, right? So that's a term spread is capturing that. And third is the credit spread. The credit quality also decides the return. A higher risky investment would have a higher return, and low risk investment, like a risk-free investment, have a very little return. So that's why we have used here a different model compared to Pharma French 3-factor model.
Okay, yeah, I'm just wondering. I'm saying again, I'm not really an expert on this topic, but maybe because if you can maybe capture some kind of bias inside of each well, mutual fund that you have, maybe inside of the high capitalized funds, you can have a bias for that kind of fund, and maybe for the small capitalized funds, you can have another bias. No, maybe. No, I'm just thinking on maybe you can have some other explanation on common factors, or maybe some bias for the high capitalized, or for more money inside of each fund that you are trying to replicate. It's just like an open question. Of course, I'm not an expert.
No. But what kind of bias are you indicating, Fernando?
Yeah, for these funds that have, let's say, for if you have a total of the worth of all the funds all together, maybe you can split each of these funds for having shares as you have in the table, no? And then you have the high capitalized, meaning that you have more money inside.
Yeah.
And then for the small capitalized, to try to capture, maybe there are more common behavior inside of the high capitalized and the small capitalized together, with all these factors that you have already, trying to capture something else, which is the market market return compared with the return of the fund, and the term credit, and all these things. But maybe there's another kind of bias. No, I'm just like thinking what else you can add.
Okay, you're saying that can also be based on the percent of the assets under the management. I mean, because some funds have a little more assets under management, some have less.
Can be, yes. Yeah, because you are capturing only in one line, I think, compared to the market, the credit, and the term. But maybe also there is some kind of bias because you have more, no? Maybe, I don't know, maybe it's different in those offices where they manage 10 billion, maybe it can be different to the ones that they manage 1,000 pesos, no? Can be maybe even the qualifications of the people, no? Can be also different.
That's a good point, actually. Mayank, you want to say something?
Yeah. So there are two approaches in which the mutual funds performance is analyzed. One approach is looking at the returns that they have generated. Another approach is what you are saying, looking at the holdings of the mutual fund and try to analyze the biases reflected through that holding. And we have followed the first approach, where we have relied more on the returns generated. Second approach has been followed by some researchers. What problem we came across, if we want to follow the second approach of identifying biases based on the holding, as you were suggesting, is that the data with the detail is not much available. And also, in this case, we had 60 months of returns for 242 funds. Now, if we want to look at the holdings data, we cannot look at holdings data of 242 funds simultaneously. So our sample would have our sample size would have declined. So which we do not want it to. Perhaps that can be another study, looking at a smaller sample size, but looking at the holdings and trying to capture its bias. That can be a different study. Again, investigating the same question. Same question can be investigated with a different approach.
Yeah, true. Thanks.
No, good. Somebody, please ask. I'll turn off the light in the back. This is no problem.
More questions?
More questions? You can also ask in Spanish if somebody wants to. I mean, we can translate, me and Larry and Fernando and everybody. But if somebody feels comfortable asking something in Spanish, please do. No problem. Pueden preguntar en español si se quieren. Bueno.
Okay, I have a couple of comments.
Okay.
Some of them non exactly related to what you're doing.
Sure.
The first part, when we see that growth in mutual funds, I find it quite interesting. Do you know if it's a growth in people investing, or is that the people that were investing there are increasing the amount of investment they are doing there?
So yes, a large number of people have started investing in mutual fund in India. And what has happened is there is a organization which represents mutual funds in India. It's called Association of Mutual Funds of India. Some 5 years ago, this organization came up with a educational and promotional initiative, which is called Mutual Fund Sahi Hai. That is a Hindi, it's an Indian language word. It means mutual fund is the right investment. And because of this initiative, almost the entire generation, young people of the age of 24, 25, young earners, they have started investing in mutual fund. So this is reflecting the number of investors also, as well as the increase in the asset under management also.
Okay, I mean, it's not related to what you're studying, but I find it interesting to see what's going on there, because I mean, that's great. That means that it's younger people that's starting to invest, and that's a change in behavior of investment.
Yes.
You know, that's quite interesting too.
And also it is also like, because Larry, there's also one more thing of the tax incentive. So for example, I'm not in that 20 to 30 age group. I'm the older guy, but I've also invested, because when we are
you have the tax deduction.
I have the tax
deduction. So
deduction.
there are certain categories of mutual fund which gives tax benefit in India.
But I don't know if you can really say that there's a change in behavior, no? Because maybe the old people already started when they were like 18 or 20 years old. You don't really know.
There's a growth in the number of people.
There is a data collected. What is the incremental month-on-month increase in new investors, from which cities they are coming, and what kind of age bracket they are falling into. And these three information gives that they are younger ones. They are coming from smaller cities of India, not from the larger cities. So what is happening is the investor base is broadening, and at the same time it is getting deeper also. Like the mutual funds are going into the hinterlands of India, not limited to the larger cities.
Okay.
Right. Another one that I think, of course, it might be because of the presentation, but you have a sample of the total amount of funds, and the question would be why you have reduced the number, and what are the reasons behind that? That was not clear during the presentation, and I think. I mean, you might have it in the paper, but it would be important to know why we reduce the number of observations.
No, it's a simple thing. So with the total, I mean, there are 329 funds that was total in the sample. We have
that is the universe. That's the population.
Yeah, that is the population, 329. But we have taken a subsample. We have taken a sample of 254 because we were trying to get 5-year data for the funds. So from April 2015 to March 2020. So not all funds had 5-year data.
Okay, great. I mean, but that's a good reason, and that simplifies. Okay, why we did do that at that moment, and then the conclusion you have actually, I find it quite consistent, but you have the data that might help you to say, okay, why some funds have not style consistency, and I think that there might be a reason to increase the performance of the fund, to have a high return, because you have some cases where you have this fact that actually you have not management style consistency, but then you have like high returns. And then it might be the case that actually, if I follow the style of the fund, then I will have like lower performance in the sense of profit, and then I'm just being flexible and changing the management style, following to have a little bit higher performance, and then I generate the inconsistency.
So two studies that we came across done by Brown, Harlow, and Zeng in 2009 and 2015. Both the studies have indicated what you have said. If you are inconsistent, you will be generating a better return. This is the American study, US study. This is the conclusion. Our conclusion is opposite to that. It says that if you are inconsistent, your returns are not so good. But if you are consistent, returns are good. So our results
but you had some examples there where you have actually a low consistency, and then the R squared was quite high.
Right.
So there are some examples of that.
Few of them only. But on the larger scale, we found a strong positive relationship, correlationship between the style consistency and risk-adjusted performance.
Okay.
Which was different from what the
Americans did find. Okay,
yes.
That's great. And then about the electricity consumption,
Yes.
I think that if you try to do it worldwide and you try to get like information for several countries, you have to take into account a lot of things additionally. For example, electricity price. Right now, Europeans are having a spike in the electricity prices. There's a huge change there that will affect, of course, behavior too. No, and then, for example, in some places, the investment in home production. So you put, for example, solar panels, no, and that kind of stuff, or you put solar heating, no, and then you might have this kind of impact, and that would be incredibly different across countries. No,
Yes,
so you will have countries with that, and then I mean, if you do it worldwide, you have to incorporate there a lot of information. A lot of information about electricity price and that kind of stuff.
So even in India, the electricity price is not one. Okay, there are 5 electricity grids in India, 5 grids, and within each grid there are probably 20 companies, and the price charged by each of the 20 companies is also not the same. So then there's and it also differs according to the income. So I mean, rural consumers pay a different price of electricity, urban consumers pay a different price of electricity, residential consumers pay different, commercial, like those who run shops and businesses, pay different, industrial consumers pay different. So there's a lot of difference. So actually my suggestion was to get some data from Mexico in a particular area, let's say Guanajuato, because you are all in Guanajuato, that's why. Because even in India, this study we are not doing for India. I mean that I should have mentioned, because I did this in a very rushed way. I prepared the slide. This we are only thinking of Ahmedabad, thinking, and only a part of Ahmedabad, because in Ahmedabad itself, the city. I mean, Mayank is from Ahmedabad. I don't know the size of the city. How large is the city? 20 kilometers by 20 kilometers, something like that.
It's yes, you can say around 500 square kilometers, sorry.
Like around 500
square
kilometers. The population of the city is 7 million. So it's a it's a tier 1 city, right? Tier 1 or tier 2?
Tier 1 city. So if you look at it, Ahmedabad itself is as big as perhaps Croatia or many European
it is larger than New Zealand.
Countries.
It is larger than New Zealand. New Zealand has 4 million people. But the whole point is
it's larger than Finland. Finland has 5.
Yeah, so Larry is actually from Finland originally, but then changed to Spanish. But anyway, so the thing is, so the size of Ahmedabad, to all the audience, it is large enough but not very large, and the population 7 million is not large, because in India we have at least 5 cities with population more than 14 million. So the point is, even Ahmedabad has the majority part of Ahmedabad is serviced by one electricity company. Kind of the outskirts are served by other electricity companies. So we are only thinking of the area which is served by one electricity company to keep that electricity effect at least homogeneous, because then you are having too much of heterogeneity, right?
Yep.
So yeah, so that is why I said maybe Guanajuato or something you can think of.
No, but I mean, you were commenting on having worldwide data, no? And
no. Worldwide
mixing
data
all that data.
We have to parse it. I mean, we have to. We have to moderate it and then get for individual pockets. Yeah.
Now, for example, here in Guanajuato, I mean, electricity is highly subsidized. The price we pay for electricity is incredibly low. So the effect would be completely different.
Yeah.
So, in Ahmedabad, electricity is not subsidized, but in many parts of India, electricity is subsidized.
Mm-hmm.
No,
that generates different effects, of course.
Yes. Now, in Ahmedabad, for the major part, it is not subsidized because it is a private electricity generation and distribution company. But for the outskirts of Ahmedabad, where it is a government company, it is partly subsidized. But that's not the point. Yeah. But yes, let's hear from somebody else. I mean, Fernando and Larry, they're not the only two. We also have the Antonio, who is that communist from Puebla.
Hi there. I have some issue at the beginning to hear you, but I think everything is okay now. I can hear you plenty. So I have just a question about maybe I misunderstood what you presented at the beginning, but so far I saw you get insight to the composition of the portfolio of the mutual funds. Is that right?
Yes.
No. If you do you mean we look into the portfolio of fund?
Well, actually, Supratim presented to us something like a table with proportions of the investment of the funds.
Leonel, just 1 second. How can I go to the table? Oh, here. Which table, Leonel?
You showed an equity fund that actually you were investing in. And actually, you're not studying equity funds. You're studying the fixed income funds. That's a confusion.
Right. Yeah, but just an example of the companies. Yeah, but the table was for equity fund.
So we have not. So to answer the question, we have not looked at the composition of the fund. We have looked at the returns of the fund.
Okay. Yeah, that's right. Okay. Well, then the next question had no chance then. But by the way, in India is allowed to make a high frequency trading in the market or not?
It is allowed.
It's allowed. Okay.
But it is happening generally in equity markets, not in fixed income markets.
No. Okay.
It is because of the nature of the market. It happens in fixed income market. High frequency trading. High frequency trading doesn't happen in in equity market. Doesn't happen in fixed income market.
Because high frequency trading is today responsible for more than 50% of the trade that we are seeing in the market. So, just a little technical question. When you were pursuing all these regressions with all this amount of data, you have to check the assumptions of, let's say, Gaussianity about the return or excess return of all this data. How behave actually the data with the assumptions of the regressions?
Can you I don't understand the question.
Actually, when you are running a regression, you are assuming some distributions assumptions of the data. So it means that if you have actually a multivariate distribution in this case, if you are making a regression and the data do not behave well, let's say in this mode, you have to make some changes in order to validate actually the regression with a data who is not following the assumptions. It's statistical assumption, I guess. So that is why I was questioning about how your data fulfill of this assumption that you have to assume in order to get, let's say, a good fit.
So, shall I respond? Yeah, we have checked the normality of the data, we found all the variables, all the indices plus the fund return, they are normally distributed, approximately normally distributed. So that one assumption is there. We also did not found any multi-collinearity problem. We did not found any heteroscedasticity problem also. Neither we found the problem of serial correlation. So major assumptions of regression are not violated.
But we did find serial correlation, right?
Okay.
No. There was no serial correlation.
No, there was, yeah.
We did,
Yeah,
there was some test we had done, and it was not showing serial correlation.
Actually, in the future, one of the, Vinod, Mayank's supervisor, and me, we thought of trying to estimate a VAR, like a vector autoregression, or like a GARCH-like model, to understand some of these tendencies in the market return. Because what we are actually, the left hand side of the equation, it is not the market return. It is the fund return, because it is the change in the net asset value. So we have the change in the percentage change in the net asset value. So can we have some kind of a time series expression? Like a time series analysis. The time series expression is there, of course, but some kind of an ARIMA or GARCH model. That is what we are thinking.
Okay.
And we would also like your inputs on that.
Thank you. The other, well, this is just maybe a way to go around all this assumption of normality and so on, is to get a model using non-parametric techniques, which
Correct.
Manuel have a lot of idea how to do it, and almost every procedure is already programming in MATLAB or in R. So that is maybe an opportunity to make a second paper with the same data, but using another technique to get the coefficients of the regressions, without this question about the multivariable distribution of the returns.
That's a good idea. That's a good idea.
And do not let bother you with this age, which is an open question about for almost a century, because when you use normal regression, every parameter you use is
multivariate distribution.
Well, actually, you use the maximal likelihood estimator for doing a regression. But when you use a non-parametric regression, you have always this problem with the we had the windows, the bright of the windows, and this is an open problem for a statistician for almost a century.
Yeah, Mike, you want to say something?
Yeah, I think we will keep this in mind. We have focused on the basic assumptions of normal distribution, serial correlation, multicollinearity, and homoscedasticity. So we have not looked at the advanced things here. So we will keep this in mind, and that is the reason why I think Dr. Madhavan has suggested to look at the vector autoregression.
Thank you.
Yeah.
Thank you.
Okay. Any more questions?
Any more questions?
No. So we thank you very much for your presentations, and we have your certificates for your participation in the seminar. I will share it in the screen. So
you can send through email. It's okay.
No. We will send it through email. That's for sure.
No problem.
But we have these, so you can check on.
Yeah, I wanted to ask a question.
Yeah.
No, it's okay. But you have. Yeah, it's okay. It's okay.
So this is for Mayank Patel, and we have promoted you to doctor. So I mean, we hope you that you will get your title very, very soon. So basically, it's already with your doctor title there for your seminar with the.
So I'm yet to get it.
Style. And of course, Supratim will also have his own.
Okay. So I think you have shared, right? Okay, you have shared screen. So my screen sharing is gone. Great. No problem.
I have shared screen.
Okay.
And this.
So I had a
question.
I had a question. Actually, Mayank was very interested. Yeah. Thank you. Actually, Mayank was very interested.
I will stop sharing it.
Yeah, no problem. And just one correction to Larry is that it is not University of Ahmedabad. In India, we have the other way. It is Ahmedabad University. So when I was in Guanajuato, my parents used to say, you are in Guanajuato University. I used to say, no, it is University of Guanajuato. So this is the nomenclature. But anyway, so it's Ahmedabad University, and it is a private non-profit university. It is not a state university like Universidad de Guanajuato, because the state university is Gujarat University, because Gujarat is the state where Ahmedabad is. So anyway, the very important question that Mayank actually had asked me a long time ago when he came with his proposal that, so the process was, Mayank, I am just promoting him because he needs to be promoted. He has been working in this industry for a very long time. So he started his PhD much later, and he's older than I think, most of us here in the presentation, probably a little bit older, but he started late. And when he proposed his idea to Vinod, his supervisor, the other co-author, he then said, like, Supratim, can you be the co-evaluator? And then we started talking, but like Mayank wants to extend this work to Mexico if possible. So is there data available, for Mexican mutual funds, or from where we can get it, or how we can get it? Or
Fernando, do you know that? Or Leonel? Because I have no idea.
No.
Don Fernando?
No, I cannot really recall where we can get. We can try to search, and I can get back to you if we have something.
Sure. Please do. If you can get back, that'll be great.
Probably Banco de Mexico has some information about that, but what extent, or for example, I don't even know how successful are mutual funds in Mexico. Is people actually investing them or not?
INEGI could be another source. They have plenty of database think about the economy and finance of this country.
Yeah, I will.
So what is the name of the financial markets regulatory agency in Mexico? They may be collecting data.
Well, actually, we have the BMV, Bolsa Mexicana de Valores. Yeah, and we have this CBN, well, let's say is Comisión Nacional Bancaria, CNB.
CNB, I think that would be the entity.
But INEGI also developed a lot of economic studies and have a lot and well revised databases and
yeah.
I would look also at this site.
Yeah. No, sure. We can also work on something, no problem. Because Fernando especially is a very, very well-trained econometrician, and especially time series econometrics. Fernando.
Oh, thank you very much, but not really.
No, you have published in good journals, right? I still remember, Fernando. So
I share with you a link of the commission of the CNBV that Leonel was speaking about. So maybe you can have a look.
Chat.
Of course, it's in Spanish.
Chat.
The chat is where you have participants. Just nearby, there's like a kind of globe.
Yeah. So you've shared it there, Fernando?
Yes, I shared it.
It's shared in the chat.
No, but I'm not a
link,
member, so
so
I cannot see in chat. I cannot see chat. I'm not a member.
Oh, okay.
okay.
Oh, that's a little bit more problematic then.
You can send through email or WhatsApp or whatever.
Okay, great. Yes.
So CNB, INEGI is the other one, INEGI, Mayank. So
Yeah.
that is the Institute of the Statistics and Geography Data.
Yeah. Instituto
that one,
Nacional
and
de Estadística y Geografía.
And you have Banco de Mexico.
Yeah.
What about other countries like Larry, like you know about European countries, mutual fund, Finland, for example, or Spain, or it's not popular at all?
No idea. I don't work finance usually, so I'm not aware of those kind of things. But I mean, in Spain, it's the Comisión Nacional del Mercado de Valores.
Yeah, there are some studies related to Spain I came across in literature.
Mm-hmm.
Just give me 1 second. Just give me 1 second. I'll be back. But yeah, please continue. I'll be back.
But my guess is that, for example, Finland has, well, not. I mean, the fact that they invest, of course, but I mean, it's just a 5 million population, so probably the behaviors. I mean, it's a little bit different. I mean, because this, for the size, just because of the size, you will have probably different stuff there going on.
Correct.
So I'm guessing that Germany would be probably better.
Germany, yes.
Germany, England, and Spain is quite big. So
yes. Even I mean, Mexico may be having it because I believe Mexico per capita GDP is 5 times that of India.
Mm-hmm.
And I think there will be a large investment happening in mutual fund. We need to find that out.
Well, the question is that in Mexico, I mean, it's a large country and we have a large population, but then the people that actually is access into financial markets is quite low.
Okay.
And what tools they are using to access the financial market, actually, I don't know because I'm not working.
So I think this is the same case. This is the same case in India also. We have a population of 1.4 billion, but the people who invest in financial market are only 15 crores, so 150. Let's say 150 million only. So 1/10 of the people in India invest in financial market.
That's probably quite close in Mexico. I will guess that 10% of people are investing in some kind of financial asset, but I don't know what kind of tools they are using in. So I mean, what is their access to mutual funds, for example? No, so I mean, I don't know, really, honestly,
Right.
No idea. Finland people do invest a lot. I mean, they used to have a portfolio, even like middle class families and so on. So there's a large percentage of population that actually is investing in something.
So there is a close relationship between GDP, per capita GDP, and mutual fund investment.
Yeah, sure.
Higher the per capita GDP, higher the mutual fund investment.
Okay. Yeah, we can get access to data and like I have contact with all of you, so I will ask you for like suggestions if we can work on something next year or something. We can also do that, and then I can pass the information to Mayank. And about the Constancia, the certificate of Mayank, so should it be corrected because he's not doctor yet? I'm not sure.
I think yes, it should.
But did you put? You have an MSc?
You mean post graduation?
Yes,
you have a master's title.
Yes, I have a master's.
No, because I mean we have to put then the proper title. So I mean then we drop you to MSc.
No. See, okay. Then yeah, it has to be. So like Mayank in Mexico, it is like like let's say,
It's a Master's of Business Administration.
MBA.
MBA.
Oh, MBA. But I mean, you have a master's degree, so
right.
You are in Mexico. You are maestro. So basically, there would be M tier. I think it's M tier O.
Yeah, maestro. So you will have to you will put it MTRO like before his name, right?
Yeah.
So I think better, Larry, because it will be difficult for everybody to understand. Better is don't put anything.
Here they always put this kind of
No, actually it will be more
titles there.
confusing. It will be more confusing.
Yeah, this is actually too much from our culture to put something like that before the name. But
So in India, it's you only put it if you have a PhD, then you put doctor, or you don't put, or you don't put like anything.
No, here if you have a bachelor, you put here licenciado.
Oh.
Yeah.
And you put the title on the wall of your living room. There is a documentary from PBS, Public Broadcasting System from the state, where they are interviewing Kahneman and Tversky, and there were a moment in where the person who was interviewing asked for the Nobel medal to, I think it was Tversky, yeah. And you have a look of the desk of the guy. Yeah, that was crazy. Mountains of papers and books on the desk and so on. Yeah, and he started to think where I put the Nobel Prize. Yeah, he started to open once and another partition of the desk and so on. At the end of the search, he found this piece of how do you say it? I just have the name in German, Kiste, una caja cuadrada, ¿cómo se llama? Well, this piece where they give you the Nobel Prize because they give you not a medal, they give you like a piece of something with the medal inside, yeah? And he found it at the end of the search. And we put the bachelor picture on the wall.
Bachelor degrees on the wall.
No. But no, I'm serious. I think it will be more confusing. So it will be better if you don't put like anything.
Okay, I will ask Luis.
Yeah, don't put anything. Just put Mayank Patel. That is fine.
Okay.
And in India, we only put doctor for PhD or for medical, like doctor. For medical doctor, you put doctor also. But yeah. Anyway, so thank you very much for the opportunity. I think we can end now. I think because it is 11 o'clock at night. Don Fernando, muy bien, muchas gracias.
Thank you very much, both.
Okay. Thank you.
Have a good night.
And the rest are all fine. I mean, this what's her name? Edgar and Antonio and Anna Karen. I saw her, but I think she's now in Oregon.
No, Anna Karen is in Oregon, and others, because we are working online. Others have also moved with their family back and that kind of stuff.
So Larry,
there's some people. No, I'm in Guanajuato.
Okay. You're not in Spain. I thought you meant.
No. I did not move from out of the country. I mean, I have not gone to Spain for a very, very long time. Wishing to go, but I mean, I will not get into a plane to get across the Atlantic during this situation.
Oh, yes. Okay.
No, and actually, I'm right now teaching hybrid, so I have some classes with students.
So how is hybrid done? I mean, in the hybrid,
you have most of your students online, and then you have few students in the classroom. And then you simultaneously you broadcast what you do in the classroom to the rest of the students.
So there's a camera. Is the camera in the classroom?
Oh, there's a camera, and then you have the laptop, and you have all. I mean, so you combine with the laptop and the camera and the blackboard and what you have in the. I use Campus Digital. That's Moodle. So you have a student in Moodle, then you can use the blackboard, and you have some students in presential.
Yeah. Okay. No, we do the same thing here. Here in Ahmedabad University, because I'm teaching, it's hybrid. So the professor has to be present in the classroom. Half of the students are in class, half are not. But the problem is now, I mean, Mayank is also working, I think, also in a university. But the problem with this hybrid, what is happening is students, they are changing at least here, they are changing their mode of learning. I mean, like I mean, 1 week they come to class, then they say, no, I'm feeling sick. This happened, that happened.
And we have them sign papers and that kind of stuff that actually, if they are going to be presential, then they have to stay presential. Unless something happens, no, if they get sick or something like that.
Yeah, but no, here also it's the same thing. But this something happens, if they write and say we are sick or something happened, then I will join online. And once you're online, then nobody knows, no, what you are doing. And also the problem is, Leonel, the problem is they can also choose certain classes that they are joining online and certain classes that they're joining offline. So the craziest thing is some students come to campus and they join a class from their laptop sitting in the canteen or sitting in the cafeteria.
Yeah, I know the issue. One day I asked the guy, where you are? There's a lot of noise. And he told me, well, I am using the opportunity to ride with my family to make the shopping. And I said, my goodness, it's supposed to be that we are in class, not in the supermarket, no? But
yeah,
we can do anything.
No, yeah. And actually, I think in one class, one student, she very casually said, oh, I was, since I was traveling, I could not participate. So I joined online, and I think the professor asked her question or asked all students question, what something, and she couldn't answer. And later she was asked, why couldn't you answer? She just very casual, no, I was, traveling with my family. I was on the plane, so I couldn't answer. So, you're supposed to be attending. But anyway, yeah, so thank you. And I'll wait for your email.
Yeah. Thank you for joining. Have a good night and
Good
be in
night.
touch.
Yeah, thank you. And we'll be in touch and we will see. Thank you. Bye.
Yep.
Bye-bye.
Bye.
Thank you. Bye-bye.